On the 1st of June, around 3 million Australians are going to wake up and their HECS debt will be bigger than it was the night before. Not because they borrowed more, not because they missed a payment, just indexation. And I spent the weekend going through every ATO page, every piece of legislation, every ABS release I could find. Because the changes to this system over the past 2 years have been enormous, and most people I talk to have only heard about one of them. So let me walk you through what's actually happening to your debt right now, what it's going to cost you in June, and whether you should do anything about it before then. First thing, HECS is sold as interest-free. Technically, sure, the ATO never charges you interest. What they do is apply indexation every year on the 1st of June, and the government's own Study Assist website says it plainly. Like interest, indexation means your debt grows over time. That's their words, not mine. So when someone tells you HECS is free money, just remember that line. Now, the rate. For June 2026, the ATO hasn't published the official number yet. But here's the thing. They changed the formula. From 2025, we will calculate the indexation figure each year after the December CPI and WPI are released. That's new. It used to be based on March data, which meant you wouldn't know the rate until late April, weeks before it hit. Now the underlying data is already out. CPI to December 2025 came in at 3.8%. Wages grew 3.4%. The rule since 2023 is that indexation is capped at whichever is lower, CPI or wages, so that HELP debts cannot grow faster than wages. So the June 2026 rate should land at roughly 3.4%. I say roughly because the exact formula uses quarterly index numbers over 2 years, so the precise figure could shift slightly. But 3.4 is the ballpark. Let me make that real. Say you're carrying $25,000 in HECS debt on the 1st of June. At around 3.4%, that's about $850 added to your balance. Overnight, you didn't borrow $850, you didn't agree to $850, and your loan will grow over time if you don't make any compulsory or voluntary repayments. That's the ATO telling you directly. Now, before you spiral, a lot has actually happened in the last 12 months that's working in your favor. Most people don't realize how much. The big one? The 20% debt cut. The Universities Accord Act 2025 passed Parliament in July and received royal assent in August 2025. It wiped 20% off every HELP loan balance as at the 1st of June 2025. Automatic. You don't need to do anything to get the reduction. If you had the average debt of around $27,600, that's roughly $5,500 knocked off. And here's the detail that matters. The 20% reduction was applied to your student debt balance as at the June 2025 before indexation was applied. So indexation for 2025 was recalculated on the smaller number. That compounds. On a $30,000 starting debt, the 20% cut saves you roughly $210 in indexation in June 2026 alone. Not huge on its own, but it stacks every year going forward. Most of those reductions were processed by late 2025. Refunds for overpayments were completed by the end of January 2026, for most cases, with complex ones running into February and March. If yours still looks wrong, check my gov. Quick note on the WPI cap. The backdated relief was significant. The 2023 indexation rate was originally 7.1%. Under the cap, it was reduced to 3.2% on a $30,000 debt. That's a credit of over $1,100. The 2024 rate dropped from 4.7% to 4%. If you saw an indexation credit appear on your account, that's what it was. But here's the thing, people get wrong about the WPI cap. They talk about it like it's a permanent safety net. Your debt can't outgrow your wages. The WPI is a national average. Your wages might be flat, you might be part-time, freelance, in an industry where pay hasn't moved. Your debt still grows at 3.4% regardless. And the cap has only actually kicked in a handful of times this century. Most years, wages grow faster than prices and it does nothing. Right now, with CPI at 3.8 and wages at 3.4, it's saving you about 0.4 percentage points. That window may not stay open. Right now, the second change. And honestly, this is the one that affects your pay packet directly. The entire repayment system has been rebuilt. Under the old system, once you cross the threshold, the ATO took a flat percentage of your entire income. Cross a bracket by $1 and your repayment jumped by hundreds. Classic cliff effect. The new system, in effect from the 2025 to 2026 income year, works like marginal tax. Your compulsory repayment will only be calculated on the portion of your income that exceeds $67,000 below $67,000. You pay nothing. The old threshold was $54,435, so straight away, some people will no longer need to make a compulsory repayment. Let me do the comparison. Say you earn $80,000. Under the old system, 3.5% of the full $80,000, $2,800. Under the new system, 15% on the $13,000 above the threshold, $1,950. That's $850 saved per year, about $32 extra per fortnight. At $100,000, the saving is $550. At $140,000, roughly $650. Above $179,286, there is no change. Sounds great, and it is. Even Professor Bruce Chapman, who designed HECS back in 1989, called it the most important thing that's happened to the system in 35 years. But, and this is where I need you to stay with me, there's a catch that almost nobody is talking about. Lower repayments means slower payoff, and if your repayments are lower than the indexation being added each year, your debt doesn't shrink, it grows, even while you're making repayments. Here's the maths. Say you graduated with a $50,000 debt and you're earning $69,400, roughly the median salary for an arts graduate. Under the new system, you pay 15% on the $2,400 above the threshold. That's $360 a year in repayments. Meanwhile, indexation at around 3.4% adds roughly $1,700 to your balance. Your debt grows by over $1,300. Every year, while you're repaying it, to just break even repayment equals indexation, you'd need to earn around $78,300. That's the treadmill below that income, with a debt that size you're walking backwards. And 1 in 4 HELP debtors owe more than $40,000, 70% are 35 or younger. A lot of people are on this treadmill and don't know it yet. So what can you actually do? This is where the voluntary repayment question comes in, and it's less obvious than you'd think. The old system used to give you a 5% bonus for voluntary repayments over $500. That's been gone from the January 2017. No bonus, no tax deduction. And once you make a voluntary repayment, it's not refundable. But there is still a play. Every dollar you repay before the 1st of June reduces the base that indexation is calculated on. If you've got $25,000 in debt and you pay $5,000 before June, indexation hits $20,000 instead. At around 3.4%, that saves you about $170, tax-free. Here's the honest comparison though, that $5,000 in a savings account at 5% earns you roughly $250 in interest over a year. After tax at 32.5%, that's about $169. So the indexation saving and the after-tax savings interest are basically identical right now. The tiebreaker, HECS debt is cancelled when you die. Voluntary repayments are not returned to your estate. Your savings or super would pass to your family. Voluntary HECS repayments won't. My read, for most people, the voluntary repayment before June is not the slam dunk it feels like. The maths are roughly neutral at current rates. If you've got high interest debt elsewhere, pay that first. If you're saving for a deposit, keep saving. The one group where it clearly makes sense is if you're close to paying off your HECS entirely, knock it out and stop indexation permanently. Now the gotchas. And there are a lot, so bear with me. Your repayment income is not the same as your taxable income. The ATO adds back net investment losses, reportable fringe benefits, reportable super contributions, and exempt foreign employment income. Salary sacrificing into super does not reduce your repayment income, it just doesn't. People get caught by this constantly. Indexation hits on the 1st of June, before your tax return is even processed. So your debt goes up first, then your compulsory repayment comes off later when you lodge. The order matters. That $67,000 threshold will be indexed each year to average weekly earnings, not CPI. If wages grow faster than inflation, which historically they have, the threshold rises faster than the cost of living. The 11-month rule. Indexation only applies to debt that's been outstanding for more than 11 months. A census date in semester 1 2026, typically March, means that chunk of debt won't be indexed until June 2027. If your employer hasn't updated their payroll systems with the new tax tables from July 2025, your PAYG withholding could be wrong. Too much withheld gets refunded at tax time, but that's your cash flow tied up for months. If you live overseas and your worldwide income exceeds the threshold, you still owe compulsory repayments. You must lodge a return. And if you're making a voluntary repayment before June, don't leave it to the last day. The ATO needs time to process the payment. B-Pay on the 31st of May is risky. Get it in with breathing room. One more thing that genuinely surprised me. The ATO's own repayment calculator is still using the old thresholds and rates. It won't be updated until July 2026. The ATO themselves acknowledge this and point you to the Department of Education's estimator instead. So if you're trying to figure out what you'll actually owe this year, don't use the ATO calculator. Use the education one, links in the description. Look, I started this thinking the 20% cut was the whole story. It's not. The real story is that we now have a system where lower repayments and persistent indexation can trap people on modest incomes in debt that grows every year. If you're earning above $78,000 with a typical debt, you're fine. The system is genuinely fairer for you, but if you're an arts graduate or you're part-time or your early career, run the numbers on your specific debt and income, because the gap between what you're repaying and what indexation adds is the number that actually decides whether you're getting ahead or falling behind. Every figure in this video is sourced. Links are in the description. If this was useful, like and subscribe, and drop a comment if there's a HECS angle I haven't covered. This is general information only, not personal financial advice. Please consider speaking with a licensed financial advisor before making any decisions.